We've been talking a lot about Chinese stocks and you getting back into it. Talk to us a little bit about your thinking right here, because it was just last month that you pulled back on your exposure and were selling. What changed?
Sure. Yes. So thank you for inviting me, Carol.
Yeah.
Very happy to be with you again. So we had been pulling out of China. We started last November, actually, after the debacle around the Ant Group IPO and really the banishment, it seems, of Jack Ma. And we saw increasing signs that the government was going to get tough on companies. We didn't know and companies which were more than unicorns. They had exploded onto the scene, and they had become so powerful, as had their leaders, that they almost seemed to be threatening the government. At least that seemed to be our take on the government's response. So we were a bit cautious, pulled away, and in fact, our flagship fund has moved out of most Chinese stocks. I think we were out probably late April, late May, somewhere around there. It might have been a little bit later. Gradually, you never know 100% of the time. I think the online education, really nationalization there, was a real valuation killer for the market. So I think that the market's going to be under pressure from a valuation point of view for a long time now, because that sort of thing was so unexpected. Even from those of us who saw the government tightening its grip on the country. But what we have done, we did after this last bloodbath in the stocks, we did try and sort through, okay, which companies are doing things the government likes.
Right.
And what we're seeing are those that are catering to tier 3, tier 4 cities, logistics, groceries. So you've seen us buy JD.com. JD Logistics is a big part of JD.com. I think they own 70% of it. So that's probably been our biggest purchase, as well as some Pinduoduo for the same reason. But if you were to look at what we were doing in those portfolios, we were really swapping them out of other names that we think are going to be continue to be in harm's way, or certainly under government pressure, like the Alibabas, for example.
Which you've been selling, correct?
Yes.
So in terms of the recent crackdowns, Cathie, that we've seen, does it longer term generally make you more pessimistic or optimistic about investing in Chinese stocks? What's the call here? You're a longer term investor. So what's the longer term play here?
Well, if you think about what China is doing, they're doing many of the same things our own government and other governments around the world are doing. Most governments are concerned about data privacy, national security, and even concerned in some ways about the impact of social media on students and so forth. So, but we just haven't. We don't have the kind of centrally controlled government that can, wipe those activities and risks off the face of the earth as much as possible. That's just not who we are. We do know that China wants to be number one in the world, and economically, certainly. And one of the ways they want to do it is with innovation, with technology. They want to bring more of it back into their country. Certainly the manufacturing side, semiconductors being one of the most important areas in which they're investing. They haven't gotten it right. I've watched them invest in semiconductors since the early 90s.
Right.
And where they brought in a lot of Taiwan semiconductor talent, and they just haven't been able to crack the code.
Cathie, they don't want to alienate, though, global investors, do they? Or how important is it that global investors stay invested in those Chinese stocks and companies?
Well, one of the things we've been learning is, as Chinese citizens have gone out into the rest of the world, they've actually come back many times when they come to New York City or other places in the world where the infrastructure is in need of an overhaul. they'll go back to their country and say, hey, we have it pretty good here. I've heard that from a number of younger people. And so I think China has been able to stir up a little bit more of a nationalistic, hey, we have it kind of good here. And at the same time, there is the risk of social unrest because of the rich and the not so rich, or the outright poor. So they are definitely focused on that. The last thing, the biggest risk China would have on its hands, I think, is a revolution, and it could be around that. I think that's why it's stepped on this kind of mega cap stock as aggressively as it has. It realized it had just mushroomed, gotten out of control, certainly government control, and now they're coming back in to exert a little control.
So more pessimistic about China long term, or more optimistic?
I'm more optimistic.
Okay.
I'm going to turn it around a little bit. I'm not pessimistic about China longer run, because I think, they're a very entrepreneurial society. Sure, the government is putting more rules and regulations in, but I don't think the government wants to stop growth and progress at all. What I will say, though, is I'm a little more optimistic about the United States and other economies, so it's more of a relative sort of thing. The more insular China becomes, actually, the less competitive in many ways it will be, because artificial intelligence, sure, you can have all kinds of data about your own population, China or Chinese government. But in order to compete in the world, you're going to need information everywhere, and I think governments around the world are a little suspicious of what is happening now in China.
What do you think the investment environment will look like in China in 5 years from now compared to what we're seeing today? And because investors, everyone follows what you're doing. So are you positioning for the 5 years from now?
Sure. We have a 5-year investment time horizon. I think we're consolidating into the few names, and these are not in our flagship fund. These are in other of our more specialized funds. So we're consolidating our position. So we've taken it down, continued to take it down, but consolidating more towards with higher positions in names like I described. They're, really focused on tier 3, tier 4, groceries, logistics, manufacturing in China. So we'll stick with those while we wait and see, how the government wants to play this. If you think about it, one of the reasons this may be going on now is China saw what the Trump administration was like, and the Biden administration has been just as tough in some ways, but perhaps not as tough as a more conservative or hawkish administration would have been around Hong Kong. And so we've got the midterm elections in November next year. So this is their window to do what they want to do, because I do believe they're feeling like this is a little bit of a window, and if the more hawkish administration gets in later, then they will want to have done whatever it is.
That makes sense. Hey, one more question on China. Our Ben Bain, who follows the SEC, sitting down with Gary Gensler, chair of the Securities and Exchange Commission here in the U.S., and he is coming out with the SEC demanding all Chinese firms reveal more about investor risks. Basically, they're looking for transparency, and this requirement applies to companies already trading here in the United States. What are your thoughts about this? Good step? Is it going far enough? I mean, Chinese companies haven't been great on complying with kind of opening up things for the past 2 decades. What does it need to change? Have we been too patient already?
I think there's been so much opportunity in China from such a low base that a lot of investors took more risks when we were at a lower base and the growth was going to be explosive, and they were willing to do that. But I do believe with investor feedback that the SEC is saying, wait a minute, this is a more mature economy. Transparency is becoming more important now. The growth is not going to cover all sins, right?
Mm-hmm.
It isn't as explosive anymore. And I actually think it's a very good move. I don't know if China is going to comply, which means within, I think it's a 3-year time frame,
right.
Companies here would have to delist. So that is a risk, and we are thinking about that as well.
All right, got to ask about some other names that you've been buying, not just Chinese ADRs. I'm going to throw out some names. Soaring Eagle Acquisition, the blank check company, Farfetch, the online retailer, Palantir, Pfizer, Semaphore are some. Too Simple Holdings, or Dave Wilson highlighted it a couple of weeks ago. These are names that you've been buying. Highlight a couple of them in your thinking.
I
know it's a lot.
Yes. Too Simple, which it was a SPAC, and it fell to earth, and we were able to get a very nice sized position, even in our flagship fund. We are looking for autonomous plays, and autonomous trucking holds incredible promise. We believe that autonomous trucking will be able to deliver freight less expensively than rail does now. Now, if you think about it, human-driven trucks, transporting freight by human-driven trucks costs 12 cents per ton mile. That's not the way a lot of people measure it, but we think it levels the playing field. Rail is 4 cents per ton mile. And we believe autonomous trucks will be 3 cents per ton mile. Mm-hmm. So we believe that half of the freight in the United States that is delivered by rail today has an opportunity to shift over to autonomous trucks in the future. It's a huge opportunity. Let's see. Some of the SPAC names that you read out. Ginkgo,
Soaring Eagle,
Semaphore. Yeah. Yes. We're getting into areas within the genomic revolution. First, very importantly, into proteomics, a huge new field. We've been spending a lot of research dollars on DNA and RNA, but RNA is really the messaging for proteins, which actually are the earliest, where we see the earliest manifestation of disease. So it's going to be a huge new space. And so some of the names you see coming into the portfolios are those. And you're going to have to read some of the other ones.
Well, I think again, Palantir is one, and actually folks are emailing me and said, have Cathie talk about Palantir and her recent buy.
Sure. Palantir, we believe that Palantir has the opportunity to usurp a lot of AWS, Azure, Google Compute over time. It is pushing artificial intelligence out to the edge. And Palantir, because I think it's roughly 60% of its business has been with the government, much of that in intelligence agencies. Palantir is, we believe today, using technologies that we will find out about 5 years from now. We believe, are so far ahead because of their expertise in intelligence that it's going to accrue to the company's benefit in the commercial space as well. So they've entered, I think a year ago, 85% of their business was with the government. Today it's closer to 60%. And so we've got all of the commercial side to go. So I don't think people understand how advanced Palantir is technologically and how its platform technologies pushing out to the edge are going to really take share over time from the more centralized services. It's interesting that we're thinking about them that way now in the cloud.
So one other name I've got to bring up with you, I'd be remiss not to. You and I've talked about it a lot, Elon Musk and Tesla. And I think we're all still trying to get our head a little bit around what happened on AI Day and this humanoid robot that he talked about to take over boring work. How do you factor in? I mean, Elon is somebody who throws out some really creative ideas nonstop. How does that, or what did you take away from that presentation?
Yes, what I took away, especially in reading many of the articles about it, is that there are not many people who are deeply involved with artificial intelligence, and that is who that day was for. They were trying to attract AI talent to tackle the most difficult and probably most transformational opportunities, certainly in terms of transportation, all kinds of transportation, not just cars and trucks, but ultimately drones and planes, using artificial intelligence. So I think the press took away, gee, this was a nothing. It was kind of entertainment with this robot. But there they go, changing the subject again. If anyone who has been steeped in AI and wants to take up the challenge that they're offering, got a tremendous perspective on how far ahead Tesla is relative to almost anyone else. I would say Google is up there, but in many ways in autonomous transportation, Tesla is in the lead. So I don't think it was the AI Day was not for investors. It was going to go over their heads, most of it. And yet, for those who tuned in, he offered a little bit of entertainment, I suppose.
It almost
our artificial intelligence analysts were blown away.
Really?
And in fact, if you look on our website, you'll see we put out a newsletter every Monday morning, and we summarized some of the more important takeaways we had from that day.
So it sounds like, no doubt about it, you're staying with Tesla. You're still in on the company, in on the strategy.
Without a doubt. Without a doubt. Every passing day, especially the more we learn about their AI expertise and how they're really driving the space, so to speak, much faster than I think anyone else is right now. We believe they have the pole position to, and we've increased our estimate here. In the next 10 years, we think the autonomous taxi network opportunity in the U.S. will be $11 to $10 trillion from nothing today. Think about that.
It's huge. It's
11
massive.
to our economy. Now, it's not just this economy. That 11 to 12 is a global opportunity. But just to give you a sense of the size of that opportunity, our economy is $21, $22 trillion. This opportunity alone is $12 trillion in 10 years. The market will start to recognize it, and we think we will in the marketplace in the middle of this decade, 2025, the market caps will probably be scaling towards the $3 to $5 trillion range. Again, from nothing.
So even with, the chip shortages impacting the auto industry, Tesla, you still remain steadfast on Tesla despite those chip shortages that are impacting the overall industry.
It's very interesting. On the last quarterly call, Elon himself said, the chip shortage might be lessening here. I know we're hearing GM and others, but I have thrown out another thought out there. Auto sales have dropped from 18.5 million units, this is just the U.S., at an annual rate in April, to 14.75. I do not believe that is only because of a chip shortage. I think it is the beginning of a massive transformation towards electric. And so a lot of individuals are not buying cars because they know anything they buy now is going to depreciate much more quickly now that electric vehicles are taking off, and they are growing exponentially. So I think something else is going on, and it was really interesting on the Magna call. I listen in when there's controversy like this to these calls.
Right.
one analyst asked the CEO, "Hey, were you surprised that GM changed its forecast within 1 month? Were you as surprised as we were?" And Magna said, "Yes. Something else is going on out there." And I do believe it is the beginning of a massive transition away from the internal combustion engine to electric. So no, I'm not concerned about the chip shortage for Tesla.
So even after I talk to you for 20 minutes, I still have 20 minutes, 30 minutes more of questions, but I've got to wrap up. We've only got about a minute, and I so appreciate your time here. I know you recently talked with another member of the business news community. You said there's no way that we are in a bubble. You feel that way about the market, specifically when we look at the tech space? We've seen quite a run up, not a bubble at all?
Not a bubble at all. I can tell you the difference is in a bubble, and I was in the last one.
Right.
In that bubble, our strategy would have been cheered on. People would have been clamoring to get in. And sure, we've retained our assets beautifully, but the February drawdown from mid-February to mid-May was quite a big one. It was for our flagship fund, roughly 35%. I'm very happy that happened because we've tested our retention here. Our clients really know what they own. And we've set the stage for the next leg up. We have a lot of fear in the market. You hear more analysts. If you look at the ratings, buy and sell, you can look at Tesla's ratings. They're probably even buy and sell by now. Maybe it's a little more to the sell side. In a bubble, it would be buy, 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 buy. You get a lot of fear from the street. And we get a lot of incoming questions associated with risk, which we should get and are happy to answer. We get more questions about risk than opportunity. In a bubble, you get more questions about opportunity than risk.
All right. Going to leave it on that note. And I know when you talk about the names, the companies, you always often talk about your research team that is looking into these companies. And I know you credit them a lot with the analysis they do as you guys invest in your 5 different platforms. So thank you so much, Cathie. Thanks so much for giving us some time again here on Bloomberg Radio, Bloomberg TV. Be well. Cathie Wood, of course, the CEO, founder, and Chief Investment Officer of Ark Invest, joining us on the phone from Connecticut.